Okay, folks, so we have some big market catalysts that are dropping in the next couple of days, and we need to discuss exactly what they are and what you need to know about them. And then I'm going to discuss exactly why the period that we are entering into this week is going to mark a huge turn of the chapter and is going to be one of the most insane, volatile, and consequential periods in the stock market all year. And I know that that is saying quite a lot, but I have the receipts to back it up. I will explain exactly what you need to know, and all of our timestamps are down below. Also, a strong shout out to Moomoo and their 10 free stock promotion valued up to $2,500, but I'll talk more about that later on. Okay, let's go ahead and start with the market situation heading into this week, so we know the context of which we are building from. The best way that I can describe this market that we've seen over the last week is a calm within a storm. This is a heat map of the 3-month returns on the S&P 500, aka what stocks in the S&P have done over the last 3 months. And you could see some pretty blaring red in technology, communication services, consumer cyclical, financial, basic, utilities, industrial, consumer defensive, and so on and so forth. Even energy has been a little bit slow the last few months. Here's the year to date though. Obviously, a more extreme picture where you have stocks like Amazon down 30%, Microsoft 20%, Apple down 17%. The only segments doing well are healthcare and energy. And then you look at the last week. Bouncy McBouncy. It's like a little bouncy house. Pretty much green everywhere, with the stocks that have done the worst this year ending up doing the best this past week. The only trailers are pretty much that energy segment, which recession fears have started taking prices, so people are worried about a bludgeon on demand and thus less profits for these types of companies. Same exact reason that you're seeing the industrials and the utilities and the basic materials declining. At the same time though, that drop off in energy prices and overall energy commodity has caused people this past week to say, hey, maybe the Fed is going to be a bit more dovish than expected at the next meeting or two. Maybe in the short term, instead of getting a 75 basis point hike or a 100 basis point hike, we're just going to get a 50. And then maybe you get another one of those contrarian rallies that lasts a couple of weeks and causes a lot of short-term alpha-focused trading hedge funds and overall short-term money to pile in and try to trade off that trend, try to trade off an overall squeeze on the market. A market that may have gotten too bearish too quickly if the Fed does end up not being as aggressive as the market is priced in. This isn't me saying that, that's what the market is saying this last week. On the broader trend, the S&P 500 is testing a change into an upward direction that it previously and especially failed to achieve at the end of June here. And if you look at the bigger picture, it hasn't had any sustained and aggressive fake out since essentially March. There was this fake out in May, but it was very, very weak. And that is to say, from a market perspective, most of the last quarter, really, you have had most of the participants moving to move stocks down via either selling holdings or dumping shares short. And when that happens so consistently and consecutively without any sort of sizable contrarian rally other than a little bit of a hiccup and a burp, well, if that happens for a long enough stretch of time, eventually you get overdue for a contrarian rally that is sizable. I've shown many graphs, but if you look at, say, the dot-com bust, you had so many contrarian rallies, your head would spin off. There are periods of time that were so damn contrarian that you got 6 months of a bull trend. Yet this time you haven't had any real sizable contrarian breathing room. Again, a small one in May, but the only one we really had is that bigger, more sustained one in March after the first FOMC hike meeting. So I mean, part of me feels as we test these breakout levels over not just late June's highs and failed attempt upward, but also the overall downward direction under our reg directional SMA and failure to really break out far above that, that there's this general energy in the market now present that says we are basically overdue for a contrarian rally. You feel that general, okay, we're bearish, but hey, how bearish, how quickly can you be? And that's the kind of energy that is vibrating throughout the market, especially this last week. Now, while I do feel that energy, I have to tell you that you look at the cycles and it's a little bit different. You look back at the recent history of the market and the playbook that we've seen all year. Remember, this is what we've seen again and again. You see markets dumping prior to a Fed meeting, but then after the Fed meeting, markets rally as the Fed has chosen to do the bare minimum to fight inflation, and markets get more clarity, which causes them to what? Rally. And if you look at the S&P 500 or triple Q chart after that June 15th FOMC meeting, and also when we posted the video talking about how this is the cycle that always plays out, well, guess what? That cycle played out exactly again. You look at that overall trend, we exactly got the same thing where after the FOMC meeting, that market's tanked on prior to, well, all of a sudden you get the bouncy. But then eventually, where does this step in the cycle lead? Well, you just look at the first here. Well, step one repeats and all of a sudden new data comes out and it looks bad. That bad data trend usually starts with the CPI, which is released on Wednesday, or it starts with the PPI, which is released on Thursday. And shortly after that, markets digest these inflation reports by essentially tanking, expecting the Fed to have to be even more aggressive at the next meeting, but then the Fed ends up doing the bare minimum again, and stocks rally afterwards. So it's like, from a technical standpoint, we are testing a crucial breakout point for a contrarian rally, but from a Fed market cycle standpoint, we are in a normal cycle of general rallying after a Fed meeting, and thus due for another bad data taking cycle. My thoughts, because you can't have it both ways, well, my thoughts are you're probably going to start seeing a more blunted reaction to the inflation narrative, not just this week, but over the upcoming months as well. And the reason is because now we're going to be a lot more earnings focused. Earnings season starts this week, but there's also the other argument, which is that inflation is going to lose its front runner status as the biggest problem. Why? Well, firstly, the CPI report released on Wednesday is expected to be slightly hotter than the last report, which is bad, 8.7% year over year versus 8.6% year over year that we got last month. But there's also this general understanding that, hey, wait a second. Okay, great. We're about to get the report for June, and energy prices were really hot in June. But energy prices are already having a very, very less expensive baseline for July, which means that the report that we get this month in June is probably going to be a short-term peak and perhaps the last peak of accelerating pricing pressures. If inflation's no longer getting worse, then the pathway that the Fed has laid out for the next 2 years is going to be more likely to be hit and not be more hawkish. It might be more dovish, but not more hawkish. The Fed, at the very least, isn't going to raise rates a lot faster than it has said if inflation does start going down, right? So once inflation has started convincingly peaking, all of a sudden, boom, the multiple crunching narrative is behind us. We've already crunched multiples and everything is good from that perspective. But then the other side of the equation is, okay, well, great, multiples on earnings are now set more in stone. But what about the earnings themselves? And all of a sudden you have the sell-off based on earnings. And when you go back to the main point of this video, the reason that this week starts the most consequential week for the entire year in the stock market is because this is when earnings week starts. This is the start of a new chapter where markets are fixated on earnings, and not just on, oh, the Fed and inflation. Here's the thing. We could talk about inflation and Fed crunching multiples on earnings all we want. But as long as companies are reporting numbers that aren't super disastrous, markets will have some support. But the minute that earnings actually start coming under attack, that's when bottoms start falling down to hell, and Satan's like, shite, even I wouldn't buy the dip on that. I'm evil, not stupid. Right now, there's this general idea in the market. If you look at big caps that are holding up most major indices, there's this general idea that, hey, these companies have already sold off 20, 30%. They have factored in both a multiple crunching and an earnings recession. And thus, they won't be bludgeoned much more, even if they get a huge miss on earnings or their guidance lowers quite a bit. Oh, hundreds and hundreds of big companies reporting in the next 6 weeks. Oh, don't worry, there's not going to be any huge misses on expectations there. Yeah, the market's just going to be stable little Sally. You won't see any big companies miss on earnings. Wall Street has already guessed everything correctly, even though they missed it the last couple quarters. Just look at, for example, Netflix, which is the poster child of Wall Street not being able to even price in big company earnings. Netflix had a dramatic miss that missed even the most bearish analyst predictions. And starting this week, you are going to see an earnings season start for hundreds and hundreds of major companies. And if you think that we are not going to see some shocking, if not more shocking than the Netflix style drop in large to mega companies, well, I've got a bridge to sell you. Well, technically the bridge is on back order because of the supply chain shortages, but hey, you can order it. We'll get it to you in the next couple of years, or at least by 2030. But anyways, we know that any large to mega company reporting a huge miss on earnings can just destroy the overall market and cause a few day to a few week massive panic sell that it just never bounces back from, or at least not in this current cycle. Similar to how Netflix and Meta and even the semiconductors sparked widespread panicking in the last couple of quarters. Similar to how even profit margin drops in Target completely tanked the rest of the market as people are trying to digest the implications of that. But now it's about to intensify because we're now another quarter in, things have gotten worse, and all of these companies are reporting earnings again. All of these companies that lowered their expectations are now going to be reporting if they even met those expectations. I think companies are going to range from, oh, we're starting to see signs that we're slowing down, to, oh man, my business is just completely tanking. But speaking of tanking, you know what shouldn't tank? The amount of free stocks in your portfolio. And yes, we do need to talk about the earnings, but first we got to give you a message from our sponsor. Before we get into it, I want to thank our special sponsor today, Moomoo, and their exclusive deal to get you up to 10 free stocks valued all the way up to $2,500. Moomoo is a powerful trading app that allows you to trade stocks, options, ADRs, and ETFs worldwide. What makes it powerful, Charlie? Well, as traders, we need to be willing and able to see patterns and favorable setups. Moomoo helps you track and find stocks that fit certain criteria, like having a triple bottom, head and shoulders bottom, bullish flag, and double top, as well as specific historical returns for each of these. Another thing I'd like to highlight is their extensive institutional tracking tools. For example, I can scroll through the different institutional players and pick out Goldman Sachs Asset Management and see a breakdown of their industry distribution, their recent buys, their top holdings, and so forth. I can also look at the entire industry and see which stocks have the biggest institutional position increases versus institutional decreases. And their AI monitor gives you the ability to find when there are massive block buys or block sells. They have also updated their level 2 US data feature. Now they display up to 60 levels of bids instead of 40, plus the real-time data refreshes every 0.3 seconds. These are just a few examples of the advanced tools that you can get using Moomoo. All of these features come together to help you see what the big money is doing before the rest of the market does. Anyway, sign up through my link and try out Moomoo today, and they'll give you up to 10 free stocks valued up to $2,500. Thank you again, Moomoo, for sponsoring this video. Now back to the content. Okay, so as earnings season starts at full throttle, what companies are reporting earnings this week? Well, you have PepsiCo on Tuesday. I hear they haven't been as effective at spreading diabetes this quarter. JP Morgan, Morgan Stanley, First Republic, and TSMC Semiconductors on Thursday. Friday, you have United Health Group, Wells Fargo, Citi, Progressive, BlackRock, PNC, US Bancorp, and Mellon. So the big dogs start really reporting at the end of this week, and markets are going to have their eyes glued on what these companies are saying. The banks tend to have their nose on all of the economic warning signs and red flags faster than every other company because that's kind of their business to know what's going on. And so you want to pay very, very close attention to that because markets pay very close attention to that. You go over to the calendar from Interactive Investor. The next week you have Bank of America, Goldman Sachs, IBM, Netflix, Johnson & Johnson, Tesla, AT&T, American Express, and Verizon. Again, you get something like a slight disappointment to a big disappointment from Bank of America or Goldman Sachs or IBM, or you even get more accelerating of a downtrend from Netflix, and oof, markets are going to flip out. I don't care if every single company here reports decent numbers. If one of them just really misses Wall Street expectations, you're going to see a bloodbath. And that's what I think a lot of people don't understand. People are looking for reasons to freak the hell out right now. People are looking for reasons to say, okay, the Fed is just destroying everything. Let's get out before it gets worse. And then you look at something like a Tesla on Wednesday. I've been talking about how I'm a little bit worried about the valuation over here in this kind of market condition. I get that Tesla's China factory is firing back up and they just reported delivering a ton of new vehicles in China, and their overall trend the last 5 years is great. But right now, I mean, their deliveries dropped by 18% in Q2 overall. First down quarter in a while, and profit margins should start getting crunched. I think the remnants of 2020 and 2021 froth are still very present in Tesla, and a lot of people that should be investing for the long term are going to sell at the very first sign that this is going to go down a lot. And if you get a big miss this next week when it comes down to especially earnings guidance, all of a sudden, oof, I would be very worried for the overall market impact on that, especially considering how Tesla has made its way into being one of the biggest players in the S&P 500. The week of July 25th, you have 3M, General Electric, Coca-Cola, McDonald's, AMD, Alphabet, Microsoft, QuantumScape, Teladoc, Visa. I am of the opinion that this day on July 26th is going to be a bloodbath. I think if every single one of these companies, again, reported decent earnings and one missed, boom, the market's going to freak out. I think that you could easily see Alphabet report more decelerating in their advertising spend space. I think that Microsoft could see a slowdown, a bigger slowdown. So definitely a possibility. Then the next day you have Boeing, Shopify, Spotify, Ford, Meta, Qualcomm. I think the big shockers that day are going to be from Boeing, who are likely still struggling from manufacturing slowdowns and a slowdown in demand. Ford, same problem. Meta, which is getting killed as advertising spending dies off. Thursday, Pfizer, Twitter, Apple, Intel, Snap, Chevron, Exxon, Procter & Gamble. Apple no longer has that stimmy money that went into the economy and gave people money to go and buy part of an iPhone or a new MacBook. So I think that the year-over-year numbers are going to start looking pretty damn bad. Intel, similar problem with less demand on them as a supply chain carrier. Snapchat, ad spending businesses, of course, going down. Friday, you have some gas companies in Procter & Gamble and Caterpillar. And then the first week in August, you have more heavy-hitting tech. You'll see PayPal, Starbucks, General Motors, Roku, Uber, Lemonade, MasterCard, Amazon, Block, Lucid, Plug, Twilio. In terms of heavy hitters, really the main one is Amazon, and then small cap earnings season starts the week after that. But the point is, starting this week, we are heading into the most consequential period for the stock market that we've seen all year. At the same time, or at the end of the month, we have another Fed hike decision, and we have that Q2 posting, which is either going to declare us in a recession or close to one. Next, let's go ahead and talk about the catalyst that I am watching this week. Put these on your radar, folks. So Monday, you have Fed President John Williams speaking. Expect headlines talking about his take on the chances of a recession. He recently said that he sees growth lagging below 1% in 2022, one of the more bearish members. I think there should be more bearish members, but hey, he does think that growth is going to lag, and he stressed that he supports a 75 basis point hike in July. On Tuesday, you have Thomas Barkin, who tends to lean a little bit more dovish. I'm interested to see his take on the commodity cool down and if he's leaning towards slower rate hikes. I mean, I wouldn't put it past Mr. Barkin to spark a one-day rally in the market. Oh, we don't have to raise as fast as we thought we did. And then the next day, we have to raise very fast from another Fed member. On Wednesday, you have the June CPI report. It's expected to be 8.7% growth year over year. Thursday, you have the next round of weekly jobless claims reporting, the June Producer Price Index, which is another consequential inflation report. And then you have Fed Governor Christopher Waller talking. Then Friday, you have the next Consumer Sentiment Index, the next Consumer Confidence Index. You have Fed President Bostic speaking. You have June retail sales, business inventory reports, and industrial production reports coming out. So I think that net and in effect, this is going to be another week where you get some real data. You have the start of earnings, and then you have all these Fed speakers coming out and trying to groom the market with new expectations. Now, remember, the Fed likes to work a lot with their soft power, which is how they speak to the markets and cause them to tighten on their own without the Fed actually having to go out and raise rates even more or unload even more off the balance sheet. And we've seen in the past where you had big periods of bull rallies in the overall market, like after the March FOMC meeting rally, where all of a sudden the FOMC members come out and they start saying negative things like they're going to be more and more hawkish, and all of a sudden, boom, tanky. So keep in mind, what the Fed says on these meetings is going to be very consequential for the market. And I think with some fairly recent healthy economic data that came out last week that suggested that, hey, we're still at pretty low unemployment numbers and things are still strong from that standpoint, I think this is the last time where they can really use their soft power the heaviest. Don't forget what the data says, though. Unemployment finds its lowest trough right before the Fed starts tightening and shortly after you see a huge uptick in inflation. Politicians, as you know, like to use record low unemployment as a way to say, hey, we have a very low likelihood of a recession. But record low unemployment combined with Fed tightening is actually one of the biggest indications of an impending recession over the last 80 years. So when people say, oh, hey, you know what? You can't have a recession if you have record low unemployment. Well, actually, the history suggests that if you have record low unemployment and the Fed is starting tightening, well, you just troughed. And you're about to go into a period of record high unemployment. That's at least what the last 80 years of data says. Doesn't guarantee that it's going to repeat itself, but that's what it says. Anyways, that caps off the video. Let me know what you think down below. Are we heading into more bloodbaths, or is this just the calm before the eventual massive bull rally? Make sure to hit that subscribe button if you found this video valuable. If you want to get up to 10 free stocks with Moomoo and want to try out an excellent trading app, make sure to check them out with our link down below. That caps off today's video. I hope you had a great weekend, and I'm looking forward to spending the week with you.